Hello and welcome. If you are a parent or guardian caring for a child with a severe and prolonged impairment, navigating financial support systems can feel overwhelming. Today, we are breaking down everything you need to know about Canada's Child Disability Tax Credit. Before we dive into the details, please note that this video focuses specifically on how the rules apply differently to children under the age of 18. It is not a replacement for our full guide. It is highly recommended that you visit our website to read our full, comprehensive Disability Tax Credit Resource Guide alongside this video for a complete understanding of the entire application process. This child-focused version builds on that foundation and explains how those rules apply differently to children. Let's look at why the child-focused credit matters. The disability tax credit applies to both adults and children, but when the applicant is under 18, the mechanics shift significantly. Because children typically do not have taxable income, the approved disability amount is safely transferred to a supporting parent or guardian to reduce their income tax. Furthermore, getting approved for the DTC acts as the master key that automatically triggers eligibility for ongoing monthly cash supplements, like the Child Disability Benefit. It is vital to understand that the Child Disability Tax Credit is a non-refundable tax credit claimed by a parent or guardian. This means it functions through the tax system to reduce the amount of income tax you have to pay. If your family owes no income tax for a specific year, the credit itself does not generate a direct payment or refund check for that year. When you file your taxes, the claim is calculated through the federal worksheet and applied to the supporting individual's tax return. The calculation involves two key areas. First, line 31,600 is used to calculate the disability amount, which uniquely includes both a base disability amount and an additional child supplement because the dependent is under 18. Then, that combined amount is moved to line 31,800, where the supporting parent or guardian claims the transferred disability amount from the dependent. On average, depending on your province and the tax year, this combined credit results in roughly $2,500 to $3,500 per year in total federal and provincial tax relief. While the tax credit reduces what you owe, DTC approval unlocks a completely separate, powerful program, the Child Disability Benefit, or CDB. This is a monthly, tax-free payment for families caring for a child under 18 who qualifies for the disability tax credit. Unlike the credit, the CDB provides direct monthly payments and may be issued even if no income tax is payable. The relationship between the two programs is seamless. You must be approved for the disability tax credit first before eligibility for the Child Disability Benefit can be determined. Once the Canada Revenue Agency confirms DTC approval and verifies you are receiving the Canada Child Benefit, they automatically calculate and add the benefit to your monthly payments. There is absolutely no secondary application form to fill out. How much do you receive? The benefit is income tested based on your adjusted family net income, or AFNI, from your previous year's tax return. For the July 2025 to June 2026 benefit year, the maximum annual amount is up to $3,411 per eligible child. If your 2024 adjusted family net income is $81,222 or less, you may receive the maximum CDB amount. If your income exceeds that threshold, the benefit begins to be reduced. Each July, the CRA recalculates benefit amounts using income reported on the prior year's tax return. This means household income from the previous year directly affects payments for the current benefit period. As income changes, your payment amounts may increase or decrease accordingly. This is why filing your tax returns on time every single year is mandatory for both you and your spouse to keep these accurate payments coming without interruption.
Let's talk about who qualifies. The CRA makes its decision based on medical certification in Form T2201, evaluating functional limitation rather than a medical diagnosis alone. To qualify, your child must have a severe and prolonged impairment in physical or mental functions. The impairment must be present all or substantially all of the time. Prolonged means the condition has lasted or is expected to last for at least 12 consecutive months. The CRA evaluates how the impairment affects daily functioning compared with other children of the same age. A child can qualify under three main pathways. First, a marked restriction in basic activities of daily living. This applies if an impairment significantly restricts their ability to walk, dress, feed, speak, hear, or manage bowel and bladder functions. It also includes a marked restriction in mental functions necessary for everyday life, such as memory, judgment, problem-solving, and adaptive functioning. Second, life-sustaining therapy. A child may qualify if they require ongoing intensive treatments to support a vital function, such as type 1 diabetes requiring intensive insulin therapy or dialysis, provided it meets specific CRA time and frequency thresholds. And third, the cumulative effect of multiple limitations. This is for children who do not have a single marked restriction, but experience multiple separate limitations that together create a severe impact, comparable to a marked restriction. Interestingly, recent CRA data shows that the vast majority of child DTC approvals, roughly 60 to 70%, relate to limitations in mental functions necessary for everyday life, covering conditions like autism spectrum disorder, severe ADHD, intellectual disabilities, and learning disorders.
The application process begins with Form T-2201, the Disability Tax Credit Certificate. Part A is completed by you, the parent or guardian. Part B must be completed and certified by an authorized, qualified medical practitioner recognized by the CRA, such as a medical doctor, nurse practitioner, or psychologist. The CRA bases its decision primarily on the quality, clarity, and specific detail of this medical certification. If the CRA denies your application, it can be deeply frustrating, but a denial does not necessarily mean your child does not qualify. In many cases, it simply reflects that the information provided in Form T-2201 was incomplete or lacked sufficient detail regarding functional limitations. One of the most common reasons for a child's application being denied is a lack of age-based functional comparison. For children, qualification depends heavily on showing that their limitations fall significantly below age expectations. Some level of assistance is expected in early childhood. For example, a toddler needing help dressing is normal, but an older child needing that same support represents a true restriction. Vague or generalized medical descriptions will also cause a denial. Simple statements like diagnosis confirmed or requires support do not explain how the impairment limits daily functioning. The CRA expects clear, specific descriptions of the time required to perform tasks, the frequency of limitations, and the exact level of supervision needed for safety. If an application is refused, families can still pursue approval by providing additional medical documentation, clarifying the functional limitations, and requesting a formal review or reconsideration.
If your child has been dealing with these functional challenges for years, there is an incredibly important financial upside. Approved DTC claims may be applied retroactively, allowing the CRA to reassess up to 10 prior tax years where criteria were met. If income tax was paid during those years, this retroactive adjustment can generate a substantial lump sum refund, combining the backdated base disability amount and the under 18 child supplement. Furthermore, retroactive child disability benefit payments may also be issued. The CRA will typically automatically provide payments for the two most recent benefit years once eligibility is confirmed, while earlier periods can be requested in writing. Because the CDB is income-based, the CRA will review your adjusted family net income for each applicable prior year to calculate your refund. Combined, these retroactive adjustments can add up to thousands of dollars in vital relief to help offset the long-term demands of therapy, medical care, and daily support. Don't let the complexity of the paperwork stop you from securing the support your family is legally entitled to. Head over to our website right now to read the full, uninterrupted resource guide, or contact our team for a completely free eligibility assessment. Thank you for watching, and we will see you next time.